Tenable reported second quarter results at the end of July, so I'm a bit late to the party, but this is going to be a good video. Non-GAAP earnings came in at 51 cents a share, ahead of what the street was looking for. Operating margin expanded by 540 basis points. Management raised guidance on revenue, profit, and on cash flow. The stock opened sharply lower the next morning. Now, the easy version of this story is that the market is irrational, that a good quarter got punished, and that somewhere in the wreckage there's a bargain sitting there. I don't think that's what happened. I think the market read this quarter correctly, and I think it read something in it that most of the coverage walked straight past. Per share over growth. That's the big part here, and I want to be precise about what that means, because the sloppy version of this argument is that Tenable stopped investing in its business. It didn't. It still spent nearly $196 million running this company last quarter. What it stopped doing was increasing that spend fast enough to keep the growth rate climbing. Management is now optimizing what each share is worth rather than how fast the top line moves. That's far from a bad thing, and honestly, I think it could be very smart long term. Everything from here is me showing you exactly where that turns up in the filing, and then, as a good contrarian should, I'll give you the strongest case I've got that maybe I'm wrong, because we have to look at both sides of the story. I'm doing this video thanks to CDN Ricky Bobby from the ALSTOCKTRADES community, who found this ticker first and led me onto it at a fantastic valuation. Neither of us are financial advisors. Nothing here is a recommendation to buy or sell anything, and every number you're about to hear traces back to a document Tenable filed with the SEC, so go check me if you think I'm wrong on something. Let's dig into it. Here's the claim. They didn't just get more efficient, they spent less. And that distinction matters to you because the two things look nearly identical on an income statement and mean very different things about the future. Real efficiency means the business got better at turning spend into revenue. Spending less means somebody made a call about how hard to push. Revenue grew 8.6% in the quarter. Total operating expenses fell 2.2%. And sales and marketing, the line you spend to go get tomorrow's customers, came in at $105.9 million, which is below what this company spent a year ago. Go ahead and sit with that for a second. Revenue up, selling costs down, research and development down, general and administrative down. All three of the major buckets moving down together in a quarter where the top line moved up. Management has said it expects operating expenses to rise in absolute dollars going forward, while falling as a share of revenue. This isn't permanent, it's a posture. Here's a test I ran before I listened to the earnings call. Operating expenses turning back up while growth holds would mean they're reinvesting rather than harvesting. But on the call, management said they intend to add more sales capacity in the second half than they've added over the last 2 years. They also said they're rotating spend into product development. So the harvest I just showed you is a first half posture, not a permanent strategy. And they've told us the date that it ends. So the question stops being whether they're harvesting and becomes whether the money they're about to spend actually buys growth. For that answer, we will find out in October. The second claim, and it's gentler than it sounds, is that revenue growth didn't collapse. It stopped accelerating. That matters because a decelerating business gets valued on where it's settling, not on where it's been, and definitely not on one quarter's beat. Subscription revenue, which is the overwhelming majority of this company, grew 8.9%. The legacy perpetual and maintenance line kept shrinking underneath it. And here's the cleanest evidence, because it's the company's own number. They guided the current quarter at 7.6% growth at the midpoint, against the 8.6% they just delivered. None of those are bad numbers. They're just not accelerating numbers. And when a company has been telling a platform migration story for a couple of years running, the market eventually wants to see that migration turn up in the growth rate rather than in the slide deck. And I'll say this now so nobody thinks that I'm hiding it. There is one growth metric that genuinely improved this quarter, and it's a really good one. But I'm saving that for the end of the video, where it belongs, in the case against my own bear thesis. So, what would change my mind here? 2 consecutive quarters of subscription growth turning back up. Management's own framing is that stabilizing the growth rate is step 1, which, if you listen closely, it's likely an admission that it hasn't inflected yet. Before I go any further, here is everything this quarter does not tell you. That headline operating margin is not a cash margin. It excludes $46.3 million of stock-based compensation in the quarter alone, many times the size of the reported net income, along with other non-GAAP adjustments. My full year stock compensation number is an estimate. I annualized the first half. It is labeled as an estimate everywhere it appears in the model because there's no telling exactly what the full year might look like. So this is my best guess today. The contracted revenue growth has more than one possible explanation, and the filing will not let me separate them. It could be stronger demand, it could be customers signing longer contracts, it could be deal mix or renewal timing. Contract duration simply isn't disclosed. One metric you'll see all over the other coverage, calculated current billings, is not in the 10Q. Management did put a number on it on the call. They said their full year outlook for it improved by roughly $10 million, mostly landing in the second half. I'm telling you that because it's a real bullish data point, and I'm not going to bury it, but it's a spoken statement and not a filed figure, and I'm not building a valuation based on that. And my concentration, nearly all of this company's revenue moves through distributors and resellers, and one single distributor accounts for 30% of that. Here's the claim I think is the real engine of this whole story. Tenable is retiring its own stock faster than it's printing it. That matters more than it sounds, because in software, the share count almost always runs the wrong way. Companies pay people in equity, dilute you a little every year, and file the whole thing under non-cash. Tenable is doing the opposite. The weighted average share count fell 8.5% year over year. They purchased at an average price of $20.23 across the first half. That's the company's own figure, not mine. And diluted share count is now the lowest it's been since late 2020. Now, let me be careful here because this cuts both ways and I don't want to oversell it. Buying back an average and watching the stock recover from here is a real, measurable, good outcome for anyone who held through it. Credit where it's due. And notice, I said average. I'm not claiming they timed the bottom, just that the average was well below where we sit today. But they spent more on repurchases than the business actually generated in that period. And that can mean two things to us. They saw that the stock was greatly unvalued, and this was bullish because they believed the stock would be worth much more later on. And it is as of today. Or they were negligent with the use of capital, and I don't believe that they are bad stewards of our capital. Cash and short-term investments came down over the first half. And I'm not going to tell you the buyback caused that decline fully, because other money was moving in and out too. The direction just isn't ambiguous. And here's the constraint, which I want to give you as a disclosed fact rather than as me speculating. On the call, management said there was $108 million left on the repurchase authorization at the end of the quarter. They spent more than double in that first half alone. So this pace ends, not because I think it should, because the board hasn't approved enough for it to keep going. Either they authorize more or the buyback slows down. That's a specific thing you can go check yourself. This exact pattern has run before, and it's worth a look at how it actually went. I want to be clear about what this is, though. This is not a forecast. It's an example of how this dynamic has resolved in the past, and then why this situation is actually different. Dropbox decelerated from double-digit growth down to 7.7% in 2022, which is roughly where Tenable sits right now. Then it did what Tenable is doing, only harder. It pushed non-GAAP operating margin to 40.6%. It bought back stock aggressively enough to shrink its Class A share count by 26% in a single year. That's honestly almost unbelievable. And revenue went from decelerating to outright declining. The buyback did not buy them a re-rating. Now here's the part that actually matters, because an analog without a disanalogy is just a story. Dropbox's revenue was genuinely falling and its user base was flat. Tenable's revenue grew, and its contracted revenue grew faster than its reported revenue did. Dropbox was being bundled away for free by Microsoft and Google. Tenable's demand is driven in large part by regulation and compliance, and that's a lot harder to give away. And Dropbox was carrying materially more leverage while it repurchased. Tenable's first lien net leverage sits well under 1 turn, and it let its credit facility lapse rather than expand it. It's the same mechanism with a meaningfully different company. So what's it worth? And I want to explain how I got there, because there's a decision buried in this one that changes the answer more than the growth rate does. Stock-based compensation is the argument. It's non-cash, so it never shows up as money leaving the building. Plenty of models leave it out on exactly that basis and move on. Grants at Tenable run about 4.6% of the market cap every single year. That's comfortably more than double the long-run growth rate I'm assuming for this business. So the company gets bigger and your claim on it gets smaller, faster than it grows. Cash flow per share compounds backwards, and it does that forever. That's not a rounding issue. That's the whole valuation. So I charge it, and to be clear, that isn't me being harsh on the company. It's just bookkeeping. You can charge the expense and hold the share count flat, or leave the expense alone and let the count climb every year. I ran it both ways. They land within about $1.50 of each other per share. What you can't do is skip the expense and freeze the share count, because then the compensation just quietly disappears out of the model. Running it properly, my base case comes to around $30.53. The full range I tested, bear through bull, is wide because a discount rate is an option, and I'd rather show you the spread rather than pretend I know the exact number. The stock closed near $33. So the market is already doing this math. Now, that's my interpretation, not a fact, and I'll flag it as exactly that. But look at where the price actually sits. It's inside the range, a little above my base case. This isn't a market panicking over a soft guide. It looks like a market that worked out a while ago, that when you pay your people in ownership, the ownership is real, and it's asking for a pretty ordinary return on whatever's left after that, which is a strange thing for me to say out loud, but I think it might be the truth. Sometimes the answer is that the price is just about right. These are outputs from my own model, so take it with a grain of salt. It's a range, not a target, and it's not a prediction either. So let me give you the strongest case that everything I said could be wrong. Because if I'm right that this has become a per share story, the counter is that it's still a growth story and simply got cheap. And I'll be honest, the evidence for that is honestly better than you may think. Remaining performance obligations, that's contracted revenue the company hasn't recognized yet, grew at nearly twice the rate of reported revenue. The long-dated portion is growing meaningfully faster than the short-dated portion, which is consistent with the customers committing to longer contracts. I want to be careful there, though, because consistent with is not the same as proof. It could also be a mix, or timing, or deal size. But it points in the bull's direction, no doubt. And then there's the number I promised you earlier, the one that makes my thesis genuinely uncomfortable. Net dollar expansion came in at 106%, up a full point from the prior quarter. The CFO called that the first quarter-over-quarter increase in more than 4 years, and said it was his favorite metric of the quarter. Then there's the platform. Tenable One was 40% of the business a year ago. It ticked up last quarter, and this quarter it hit a record 50%. That's not a plateau. That's a curve bending in the right direction, and it's the single best argument that the growth story isn't finished yet. So which is it? I don't know. The filing really doesn't settle it. What I'd say is this. For the first time in a while, the boring answer and the exciting answer are both fully defensible off the exact same numbers. And that's usually where the interesting setups actually live. And if you take nothing else from this one, a company can be a great business and fully priced stock at the same time. Those are two different sentences, and the market often grades on one of them. Again, huge thanks to CDN Ricky Bobby for putting this one in front of me and keeping up with it. Go follow him for his stellar work. You can find his link to his X profile in the description down below. Neither of us are financial advisors, and none of this is a recommendation. Do your own due diligence always. Thanks for watching. Like and subscribe for more, and I'll see you in the next one. All right, that's a wrap on today's breakdown. If you found this kind of analysis valuable, I want to point you toward a community that's genuinely leveled up my own research. That's ALSTOCKTRADES. It's the community and tool set I use behind the scenes when I need to build conviction in a company, find a new idea, or just get honest feedback from a diverse community of investors. This isn't an echo chamber, and that's extremely important. Whether you're just trying to build a research process or you've been doing this for years, there's something in there for you. I've linked it down in the description below. It costs you absolutely nothing to check it out, and it might just change how you approach the market. As always, do your own due diligence. This isn't financial advice. Just one investor sharing what's worked for him. See you in the next one, friends.